Hey Nick.
Hi, good morning. How are you?
Oh, never better. How you doing? You're right on the other side of the Santa Cruz Mountains from me right now. Aren't you on over in Mountain View or that
No,
area?
I'm actually on the East Bay. I live in Blackhawk in Danville.
Oh my gosh, you're in Danville. It's hot out there, isn't it?
But it was hot yesterday. I haven't been outside today yet, so I'm not sure what it's like today.
Man, I'm over here in Half Moon Bay, and all the people are coming over to Half Moon Bay to get out of the heat.
It was hot yesterday, and over the weekend it was a bit hot. My youngest daughter graduated from high school over the weekend, so we were out there in the heat. But it's not too bad at the moment.
Right on. I thought that your VC firm. Do you guys have an office in East Bay, or is it over here
No,
on
no,
this
no, no,
side?
no. We actually don't have an office at the moment. We have a small office in San Francisco right now, but our primary office was on Sand Hill Road.
That's what I thought.
But our lease was up, and when was it up in 2020, mid 2020, and we didn't know when we'd be going back in the office, so we didn't renew it. So we're gonna have to be getting a new place when we go back into the office.
Do you think that I got a question for you because I was a VC, and when I was a VC, everybody said that we had to be in the office, and then we also said that we were only investing in companies that were within driving distance. And then the pandemic, and then as an entrepreneur, I've always run remote teams and gotten a lot of hell for it, quite candidly, Nick, from some people. And then the pandemic came, and we're still here talking. These businesses didn't go out of business, and people have operated maybe more efficiently. Do you think that you need to go back into the office? I mean, hasn't it worked over the pandemic?
Well, I think it depends. So I think having an office, there are some people who prefer to work and get more work done in the office. There are some people who are actually more productive outside the office. I think it's always good to have a place where people can get together, discuss ideas, exchange ideas, jump on a whiteboard. Certainly for creative type businesses, I think being together matters. But for companies like ours, I think you need to be together sometimes, and it's good to have a place where people can get together, but you don't need to be together every single day.
So I do want to ask this question. I want to talk about the state of venture capital today and what's happening, and maybe a little bit about the economy. I read that that VC investing was down in April. It really wasn't, from my experience over the years, not significant. But I also read a letter recently, and I forget if it was from one of the VC firms on Sand Hill Road out to their companies that basically said, "Hey, you better hunker down. If you better make sure that you can live through what I don't know what people are calling it reset." I mean, this is like the perfect storm of something. I'm not that old, but I'm old enough to know that I've seen elements of each one of these things that's happening in the current economy and world at once, maybe two of them, but I have never seen like this freaking perfect storm coming together of all these things. So who knows what to expect, but they've said, "Hey, you should hunker down and get ready to live through what maybe a I don't know to say it's going to be dry, but a less rich capital environment." And at the other side, I see people still have tons of dry powder. I mean, VC firms, and there's still firms raising money. I mean, and enormous amounts of money that I'm sure they can sit on, but their IRR clock is ticking, and they're going to have to deploy that money at some point. So, but before we get there, how'd you get into the VC business?
Well, I have to say, I'm really an entrepreneur and operator, and most of my career, that's what I've been. And I never really had a desire to be in the investment business, the VC, private equity. But several years ago, back in I think it was 2006, 2005, 2006 timeframe, one of my friends became a partner, was hired to be a partner at a large private equity firm, and he tried to convince me to join him there. And I met with the firm, and it's a great firm, and I think they were very interested in me joining, but it didn't seem to me that in my mind, I didn't think I was the right fit at the time. That firm was a lot of what they were doing were, leverage buyouts and those things. And I remember saying to my friend, I'm a real engineer. I want to build stuff. I don't want to be breaking stuff up and figure out how to do financial engineering. I want to do real engineering. And so I didn't do that. And a few years later, he suggested to me that maybe we should go start our own private equity firm. So I first became a founder of a company called Riverwood Capital that I co-founded. And that's how I got into the investment business to begin with. And then, I was in that for many years and then decided I really like early stage investing. So we put together a special fund on the side just to do early stage investing. And then that turned into WRV, which turned into WRVI, and then we changed the name to Celesta Capital a few years ago. So I would say I was a reluctant VC. It wasn't a natural move for me.
Well, are you are you comfortable in it now? I mean, I'll tell you candidly, I wasn't. I got into the business and then it just wasn't what I thought. I think it's a great business and you can make a lot of money and it's certainly a great lifestyle. But building things, talking to entrepreneurs and everything is certainly fun, and having colleagues of business owners I love, mainly because I can get the ideas and apply them to my business and make more money. But I almost felt like I was sitting on the sidelines watching the thing. I'm not saying you're not in the game. I'm just saying you're not in the game. You're making bets on a mathematical equation in venture capital, which is pretty straightforward. And then, I mean, I'm breaking it down and trying to make it simple, but that's really the fact when you're deploying capital, especially investing in early stage companies. So that's a long way of saying to let you think about, like, are you comfortable being a VC, or do you miss like operating and building things?
No, I actually enjoy being a VC. I am, and one of the reasons I enjoy the VC space more than, for example, the private equity space is in the VC space, you do tend to get more involved in the company. So, we are considered value add investors. We're investing in deep tech. I'm a technologist by training, and I have started my career there. So I have a love for technology, and I like building businesses. And in the areas in which we invest, which is the deep tech space, you're not trying to flip companies, and so you're actually trying to build real businesses. And in many cases, the entrepreneurs that come to us and seek us as investment partners, they're looking for value add investors. They're looking for people who bring, intellectual capital on top of financial capital. And in many cases, I would argue that the intellectual capital is more important, or as important at least, as the financial capital. And so we tend to get pretty involved in our companies. I mean, not running them, although we have stepped in from time to time and run companies. I'm running one of our companies right now. So we do tend to get more involved, whether it's in strategy or in helping to hire, or helping people figure out supply chain strategies and things like that. So I do enjoy it. I get to do a lot of the things I like, while at the same time working with entrepreneurs to help them, take ideas and turn them into businesses, and then turn businesses into bigger businesses, and then get and in the process of doing so, you're developing great products or capabilities. So yeah, I do enjoy it.
What does deep tech mean?
Yes, that's a good question. We tend to talk about deep tech a lot as though sometimes everybody knows what it means. Deep tech really is a term. I don't know when it was coined. It was coined some time ago, before my time, but it's a term that was coined to describe the fact that you're investing in core technologies as opposed to investing in things like apps and other things. And the way I like to describe it is that you're investing in some of the foundational technologies that are essential for enabling and driving current and next generation market technology trends. So, as an example of that, things like, how do you manage, analyze, and move all of the data that we started to see being generated. So you have an exponential growth in data, And then, you have to figure out how to move the data, manage the data, analyze the data, and stuff. And the core technologies, semiconductor devices and systems that you need in order to be able to do that. Or if you're talking about the electrification of the vehicle or autonomous driving, they're foundational technologies that are required to enable these things. And those are the kinds of technologies that we invest in. So semiconductors, materials, systems, a lot of hardware related stuff. We also do some software, of course, but a lot of our investments tend to be in what people commonly call this deep tech.
Yeah, I'm going to say it back, and you can tell me if I'm wrong, but it's really in the platform, in these things that are used across all the people that may be addressing the market, so that it's almost a platform play, or every computer needs a chip. I guess for listeners out there who are thinking about it, you don't care whether it's an Apple computer, an IBM, or I don't know if they're IBM anymore, Lenovo ThinkPad, or Dell, or whatever it is, or a video card that has to be in every one of these, which allows, in general, a bigger market, and likely that many of those companies won't build themselves. So, is blockchain deep tech for you?
Well, some aspects of blockchain. So, for example, certainly the semiconductors that enable um, the blockchain proliferation it would be deep tech. Some of the systems you need, the computer systems you need, that could be considered deep tech, yes. And blockchain itself as a technology, one can say, is deep tech. The applications that are built on top of blockchain, you know, those that wouldn't necessarily be considered deep tech. But the blockchain, the core technology, would be considered deep tech.
And different forms of the blockchain,
Yes.
in essence, that people might not.
We haven't made any investments in that particular space yet. We have um, even in things like, this whole Web 3.0 and stuff, we're just starting to make some investments in that space. But yes, there are deep tech opportunities in all of these emerging applications.
You mentioned that you're running a company now. What happened?
One of our companies, the founding CEO decided that for where the company was at this stage, that he didn't think he had the right skill set, so he stepped down from the role of CEO. He's still in the company, but he stepped down from the role of CEO. And so while we look for a new CEO, I have been running the company for the past 7 months, but we're pretty close to getting a new CEO. So it should be only another month or two, and I should be able to get out of that.
Well, that sounds like a lot of work.
It is, but I do enjoy sometimes getting more inside the company and seeing more of what's happening and helping out. At the end of the day, when this company is successful, I'd be a footnote, but I'm certainly enjoying the small role that I have in helping to shape some of the strategies and help improve operational execution.
I'm going to say this lovingly, having been a venture capitalist and been in the business, is a lot of people say they're value add investors. And I mean, quite candidly, everybody says it. Because if you're not and you're just the capital, then, me as an entrepreneur, it's interesting. Although I think there's a lot of entrepreneurs who think that they just want the money because they think the money's going to solve the problem. And more often than not, I think there's occasions, like if you're going to build a chip, you probably need a lot of capital to build a chip or design a chip. But more often than not, it's not always the capital. When you say value investing, and I asked you about running the company, because that's beyond value. That's actually getting your hands dirty and jumping in. Do you have time, and do you go into your portfolio companies with more than just showing up to the board meeting? Are you going into the office? I know one VC firm that I work for, they like pawned me out, Nic. I had to work at that company 2 days a week. And I worked on their marketing analysis and financials to sort of build that out for them, because they didn't have the resources and really didn't have the money. So at the time they had capital that we had invested. Is that the type of work that you guys do?
Yeah, and typically it all depends on what the company needs. But let me back up a little bit, because you're right. Most investors would say that they're value add investors and they bring more than money because they don't want to come across as though it's just dumb money. And there are some entrepreneurs who believe all they want is money, and they choose the investors who give them the best valuation. Our position has been that you should care who your investment partners are, and you should look for value add. And while we are not pretending to be the most important value add, because value creation it comes out of intellectual capital, and most of that will come from the company. Most of that will come from the founders and the people in the company. So we are not trying to pretend that we bring more value than the people who started the company. We're not trying to pretend that our intellectual capital is better. But what I believe is that companies don't fail because they run out of money. Companies fail because of the reason why they ran out of money. And companies don't grow on a nice smooth S curve like is typically shown in business schools and so.
Are you kidding me? I spent all this money going to that business school, Nic. I mean, that's the way it really happens, isn't it?
Yeah. So, there are all of these ups and downs, or the harmonics associated with growth. And part of why companies fail is because they get themselves into one of these holes that they can't get out of, or they get themselves into so many holes that it slows them down. And by the time they get to market, 10 other people have beat them there, right? To the point. So the kind of intellectual capital we bring is the ability, based on our operating experience, the ability to help companies avoid some of these issues, help companies optimize strategies, whether it's product strategies or supply chain strategies or other types of strategies. And I believe if you can help companies avoid a lot of the typical mistakes you have, the harmonics associated with growth, then you accelerate your time to market, which is the biggest challenge startup companies often have. If you could accelerate time to market, then you increase the likelihood of that company being successful. And you potentially could, by accelerating time to market, you could also amplify the potential value of that company in the longer term. So, and what do we mean by that? It's different from others. Some companies would say, well, they added value because they helped the company hire a VP of sales. And what they often mean by that is they recommended a headhunter, or they participated in the interviews. In our case, oftentimes we are talking about, stepping in and helping the company through a time when they may not have the right experts, and then introducing them to people who are the right people for that company. And I'll give you an example. I remember we were the lead investor in GoPro. And I remember at the time we made the investment, GoPro didn't have an engineering organization. And I was talking to Nick Woodman, and he recognized that he needed to have a VP of engineering, and he asked if I can help him. And I said, well, what kind of help do you want? And he said, well, could you recommend 4 or 5 people to me, and I'll interview them and pick one? And I said, well, here's the problem. If I recommend 4 or 5 people to you, I already know which one of those people is the right one. Why don't I just tell you which one to go hire, and go talk to the person. If you don't like them, then I'll find out why you don't like them and recommend somebody else. And the first person I recommended to him, he liked, and he wanted to hire the person, but the person had a very big job, vice president job in a very big company, and he was a little startup. And he said, I don't think I can get the person. I said, I can get them for you, because it was somebody I knew well, somebody had worked for me, and I called that person and convinced them to take the job, even negotiated the comp package with the person, and the person joined. And then I actually, that person came from the cell phone industry, and Nic had some questions as to whether or not that was the right background. And I said, yeah, because a camera person hasn't done the kind of things you're trying to do. You're trying to shrink electronics and make this thing super small. Cell phone guys know how to do that. So let's hire this guy, and then we'll hire some camera guys to work for him so he can direct them. And then I created a list of some of the top camera guys I knew, and worked with this person to hire the first 6 engineers in the company. So that is an example to me of value add, or stepping in and running a company, or Michael Marks stepping in the case of Berkeley Lights, when we invested in Berkeley Lights, and there were lots of problems at the board level, and Michael Marks stepping in and becoming chairman of the board, and restructuring the entire board, changing out some of the management teams and things like that. And that was responsible for the kind of success that company had.
Well, I appreciate you sharing that story. As you probably know, GoPro is near and dear to our hearts here in Half Moon Bay, although some people don't like businesses here because they want to come here and just get away. But GoPro started here in Half Moon Bay. I think they
Absolutely, and that's where they
still
were
have
when
their.
we made the first investment. In fact, one of the things I had to do was convince my friend to drive to Half Moon Bay to work, which
And
wasn't
I
that
think
hard to do, by the way.
yeah, like I think their office they still have down there in Princeton Harbor is like a pretty nice scene to look out on the Pacific Ocean. I mean, let me pull. I guess I gotta really pull your hair or whatever, convince you to be able to do that. I remember the stories of the actual bike shop here in town was one of the Nic's first dealers. So that's a great story, and that's real. I think there's like all these words that people use, Nic, and I think they get overused. Like me as an entrepreneur, I hate people using the word entrepreneur because online everybody's an entrepreneur. And I'm not
That's
saying
right.
they're not an entrepreneur, but there's different degrees of entrepreneur. And I guess maybe you get, I don't know if the word snobby or whatever, but I'm like, yeah, you are an entrepreneur, but you're sort of not like that level. You don't get to, I don't know, I feel like they just claim it. And this value add thing, I just think is, everybody says it, but I don't know how to describe what you just said other than like you do real work
Yeah.
because that changed the trajectory of GoPro. That completely changed it. In fact, it's how they probably got public because of these moves and avoiding mistakes that, Nic's a smart guy. I mean, but would he have made that mistake? Most likely, just not because he's dumb or because he doesn't know. It's just because he doesn't have those resources, and a lot of business owners don't. So in that case, like the capital was interesting. Your connection and work was and recruiting. That's true recruiting work that you did is worth more. So no, those are great stories. I didn't even expect that, Nic. That's the exciting things about this show.
Yeah, well, one of the things I've learned throughout my career is it's very difficult, for example, to hire people. And you can sit down and talk to a person for 2 hours in a conference room, call references, do whatever. And, the chances of you being correct is maybe 50-50. But um, the best people I've ever hired throughout my career were people who recommended other people to me that they had worked with and they understood what it is I was trying to do. And they can say, this person is the right person for you. And then I interviewed the person and hired them. And that's one of the things that we bring. We've worked with so many people. We have such a big network. We can actually go in and say, here's the kind of person you need, and we know some people who will fit that. But that's just a small example. But even things like if you're developing hardware, supply chain becomes really important. How do you optimize your supply chain strategy? Who are the right suppliers for you to be talking to, and then how do you get good terms from those suppliers? As a startup, it's often very difficult to get terms from those suppliers. So even helping with things like that, helping with strategy. You mentioned one. You mentioned the fact that many VCs would say you invest in companies that are a drive away, and you tell them when they build their business in the beginning, you have to have everybody in the same location and all of this. Well, we invested in a company in Japan that's doing very well. And when we invested in that company in Japan, we changed all of those rules. The reason we invested in that company is because that company was developing some capabilities that required very disciplined core technology development. And we think Japan is fantastic for that. They have great universities, great engineering talent, and they're very disciplined around core technology development. But we didn't believe that some of these Japanese startups had a really good history of success commercializing products, especially outside of Japan. This product also required a lot of software development. Some really core to this company's success was software. So what we said to this company is, you need to set up a competence center in India around software development, not because you're going there for lower cost, but because you're going there for higher levels of competency. So it wasn't a cost arbitrage, it was competence. And then we said, let's do the product commercialization stuff, the engineering around commercialization in the US. And we convinced the company to do this when most other investors would not have done that. But that was essential in our mind for success, and it's proven to be the case because now you can locate the company in areas where you can get the best technical talent to be able to accomplish this complex development that we are trying to do. And I would say without those decisions, this company would not have been successful. And we were the ones who proposed this approach to the company and helped them through it because of our experience. When I was a CTO of Flex, I was involved in 85 acquisitions. I managed, an engineering organization that was located in more than 35 countries. In fact, I had over 100 locations. And so I'm not suggesting that's a good thing, by the way, but I am not uncomfortable having a structure like this. And I convinced the CEO that this was the right thing to do. And it turned out to be exactly that. And as a result of that, the company is doing very well at the moment.
I agree with you. And when you were talking, I realized like I come across sometimes as extreme. I think that there are times that work better for humans to be in the same room.
Yep.
I do agree 100% with that. There's just times that it's not just about being in the same room. It's about there's this human energy and connection. And even if it's disagreement, there's just a different thing that doesn't come across a screen. It doesn't. It's just a fact. It doesn't come across the screen. Not everybody's understands how to talk to one another on remote situations. Like you can't look at your screen. You have to look at the person. Otherwise, the person doesn't think you're paying attention to them. And there's all these little things that added up. And I just wanted to say that because listeners would be like, oh, Brandon's so extreme. He's beating up on Nic. But the fact is that remote can work, but human contact is very hard to replicate over the lines. And occasionally it's good to have a human connection. So, I think that's interesting. My question was like, wow, they're in Japan. Is it mostly remote or do you actually visit there?
No,
Or do you even need to?
I visit there quite often. So the company is headquartered in Japan. So in this particular case, we have our quarterly board meetings started off being all in Japan. And I wouldn't only go for quarterly board meetings in the beginning. I'd go more often for just updates or to help work on strategies. When you're having these kinds of meetings, sometimes it's better in person. The company has, however, been very kind. And now that we have a big group here in the US, we also have a group in India to help me avoid having to travel as much. They have moved half of the board meetings to the US. And
Wow.
so and at one time I was the only non-Japanese on the board, and the rest of the board would come here and have meetings to help make my life a little bit easier. But it also helped them to be able to see what was going on in the US also. So there was some benefit to that. But having, in-person meetings is also good. But just being there something and seeing what's going on and being able to talk to people. And I'm a visual person. I like to see things. So I try to travel and go see what's going on. So we have investments in India. Up until before the pandemic, I would go to India, 4 or 5 times a year, and just so I can see what's going on also.
So Nic, switching gears a little bit, what makes a company VC investable? Because a lot of people out there believe that their company is VC investable, and it can be hard to describe or to understand. So what, in your words, what makes a company VC investable?
Well, I'll answer that question primarily from my perspective because I think the type of businesses you invest in, well, some of the stuff is common across all kinds of businesses. There are some things that might also be unique to certain business. So let me caveat this by saying I'm going to answer this question primarily from the perspective of a deep tech investor, more type of hardware centric type of company. Um, First of all, when you invest in deep tech or you invest in hardware, it is tough work. You have to be investing in building. You have to assume you're going to be building a business. And so we invest from the perspective that we're trying to build a great business. Now, don't get me wrong. If someone shows up with enough money and wants to buy this even before we have a product, we'd be happy to sell it. And we've done that. We've sold some of our companies even during COVID. We sold one of our companies for 1.4 billion pre-product, didn't have a product yet. So we would do that also. But when we invest, at the time we investing with the intention of building a great business. So the company has to obviously start off with a credible business idea, credible plan. It doesn't have to be, necessarily a 500-page document or anything like that. But it has to be credible. There has to be a credible plan. The team, since it's a technology world we invest in, you don't want to take a lot of technology risk, meaning that you don't want to be investing in something where people are trying to violate the laws of physics or trying to solve a complex problems without the right skills and expertise. So the team has to be a credible team. First of all, it has to be a credible technical team where you believe that the team has the ability and the competence to be able to develop the technologies that they're saying they're doing. Because if you're investing in deep tech, you're often trying to solve really challenging problems. That's why it doesn't exist at the time. And then, hopefully the team also has good credibility in terms of executive leadership. But sometimes you'll take a risk on that one. You can't take the risk on the technical competence if you're investing in technology, but you could take risk on executive competence because you could add executive talent. You could bring in somebody to help. And as long as the company realizes that that is a gap, you can't manufacture domain expertise, technical domain expertise, but you could bring in professional leadership who can help guide, direction and execution and things like that. So there has to be a real market need identified. So you can't just come and say you have a great idea for a technology and you're trying to find a solution. There has to be a clearly identifiable solution and a clearly identifiable problem, and you have a potential solution to that. So it can't just be, here is a technology and it's a really good technology. It can do 500 different things. So let's go figure out what's the one thing it can really do well. So you have to have a good solid business. You have to have a good solid technical team, or the beginnings of a good solid technical team with proven competence. And then you have to have a real problem identified that you're developing a solution for. I would say those are some of the key things that we look for.
I appreciate you explaining that. I wrote down a question because I didn't want to forget it. Why does someone buy a company for $1.4 billion pre-product?
Well, there are a couple of reasons. Usually when that happens, it's usually a big company that has identified a space that they want to get into, and they believe that buying this talent and the capabilities that have been developed so far will significantly accelerate their time to get into the space. And the space might be big enough or so strategic to this company that they're willing to pay to be able to get there. Because it may cost them, if they were doing it themselves, it may cost them a whole lot more. But more importantly, the time it might take them might be such that by the time they get there, they just wouldn't be able to capture the kind of market share they're looking for. Usually, those are some of the key drivers.
That undoubtedly is an incredible win. All too often do I hear entrepreneurs say, I'm going to create this technology and someone's just going to buy me. And in my experience, while you've had an incredible win, would you agree that that's not the norm? I mean, a $1.4 billion acquisition requires, goes without saying, it requires board approval. It requires enormous amount of diligence and work to get there. But saying that you're going to build technology and someone's going to buy it is a pretty big risk. I think, and you've alluded to that. Well, you haven't alluded to it. You've basically said it, because you will invest in real businesses. That business that got acquired, it sounds like, had a real business plan, just hadn't gotten to putting all the technologies together to build the product. I guess my real question is for listeners out there who are listening saying, I got a technology and I'm going to sell it. I don't know that that's a business strategy. Would you agree?
Oh, I certainly agree. Like I said at the beginning, we invest in companies where we think you can create a real business. We're not trying to flip stuff. So you're investing in companies that are developing technologies that are needed, that you believe has a good fit with the market and where the market is going. The fact that you may sell early has to do more with a buyer recognizing that you're on the path to getting there and deciding to take you out early, because if you get further along, it would be much more expensive for them to be able to take you out. And also, they believe that they want what you have and you can help them to get to where they're trying to go faster. So there's a big difference between what I call being bought because you're trying to create something great, but you're not quite there yet, versus creating something and then trying to sell yourself because you think you have something that other people may need. That's a much more difficult situation.
Almost impossible.
Yes.
Did they find that company, or did that company get press and whatnot, or did this company? I'm just curious
But a
about the
lot of times
mechanism.
these things happen, not always, but a lot of times these things happen is because sometimes the other company that acquired the company, I'm not going to talk specifically about this case, but a lot of times what happens is the other company is also involved. They may be an investor.
So having strategics, that's an interesting thing, because the companies that I've had that have been venture funded, there's always a discussion around a strategic investor, and there's downside to strategic unless you write your terms right, because maybe someone else wants to buy it. And well, I guess that's a question for you. Do you think that having a strategic buyer pigeonholes you into that purchase, or do you think that those deals can be structured? And we're not talking about the deal that you did specifically. I'm saying, if Google invests in your business, does that preclude, are you selling or giving up the opportunity that Microsoft would, because you have this strategic investor and you're not going to be able to get another buyer?
No, no, no. It depends on how much that strategic investor owns. I think there's sometimes challenges associated with a strategic investor who owns so much of the company that they have um, too great an influence in the direction that the company is going, because oftentimes they can drive that company into a direction that's optimum for them, but may not be optimum for the rest of the market. But having strategic investors in general, I think, is really good for most companies. And having multiple is good as long as they do not have undue influence over the startup that causes them to drive the startup in a way that benefits their company, but not really the overall market or the startup. But remember that even if you have a strategic, in the cases I gave you, um, the generalization I gave you, it doesn't always mean that the strategic that was an investor ended up acquiring the company. The strategic that's an investor may have made the first pass at acquiring a company, but others sometimes come in. You have cases where a strategic who is involved in the company initiates something, but it's somebody else who came in and paid a lot more money and bought the company. So you have cases like that as well. But the advantage a strategic has is because they may already own some percentage of the company, the cash outlay that they have to put out to acquire the company would be less than somebody else who came in and doesn't own anything. So you can imagine if a strategic has 20% of a company and the company is valued at $1 billion, they only have to put up 800 million, whereas the other guy would have to put up $1 billion. And so, you can say that gives them a little bit of an advantage, but depending on how important this is to a company, that difference of 200,000 may not matter as much, as an example. But I personally believe having strategics is always a good thing. I don't think there's anything wrong with having strategic investors, as long as the strategic investor does not have undue influence. And when I say undue, I want them to have influence, because having a strategic helps you to understand the market requirements, help you to understand the competitive landscape. It helps you to understand all of those things. So you want all of those things, but you don't want the strategic being able on their own to set direction for the company.
I think that makes sense.
So having a strategic
Um,
that owns 10% is could be good. Having a strategic that owns 90% may not be good. It's
Yeah,
probably
I'm
not
not,
going to be good.
I'm not signing up with unless there's a clause in there that says they will buy us after 5
That's
years
right.
and do something. What do you think about the state of venture capital today as it relates to all of these crowdfunding opportunities? I've talked to a CEO that took his company public, raised $100 million in crowdfunding. He has argued that it's an easier or better route because VCs can get involved. And the truth of the matter, I don't know if that's the right thing. The truth of the matter, the way that the system is set up is that investors in your company, not just VCs, angels, anyone, are not traditionally aligned with the company, meaning the fiduciary responsibility of an investor, if you're a VC firm or your private equity or whatever, is to get an IRR for your limited partners. That's just a fact. It's not to look out for the best interest of the company. It's to look out for the best value that the company can give to provide a return. And that's not bad. That's just the dynamic. It's just the way it goes. And his position was that while the capital from those investors, private investors, still has that dynamic, it's not at such a large ownership value, meaning one firm doesn't own 20% or whatever in that situation and have blocking rights and approval rights for anything over $100,000 in spend and things like that, which maybe those terms don't come up anymore. But I have seen them in deals. Where do you feel like this is going? Because an entrepreneur can sign up for these sites, and there's marketing and all sorts of stuff you have to do. But is the VC money going to have to compete with that money? Is it complementary? How do you see this all shaking out as we move forward?
Well, first of all, I don't think there's anything wrong with crowdfunding, and I don't think there's anything wrong with some companies deciding that's the funding path that they want to take. They can do so for various reasons. I look at this from a couple of perspectives. So first of all, if you believe that the only value you get from a venture capital firm is money, and you can get a cheaper source of money elsewhere, then you should take it. If that's true, if all you need is money and you don't need anything else, you don't need relationships, you don't need intellectual capital, you don't need anything else, all you need is just money, then you should take that money from the cheapest source that you can find for that money. And oftentimes crowdfunding will be the cheapest source. So that's okay if it works. I don't know that there are a lot of examples, by the way, of crowdfunding leading to great successes. If you look at some of the crowdfunding platforms and you look at the success ratio, it's not that high. So the question is, why is that? I'm not gonna sit here and be critical of that. I think the venture world brings more than money. And I believe that most venture capital investors believe that the best way to be successful and to give great returns to your LPs is to build great businesses. So I don't believe that venture investors get into a business with the intention that they can bring great value to their LPs by, just flipping things. That happens. Like I said, that happens. But I think most of the serious venture capital investors are investing with the intention of creating something valuable, either a valuable company or a valuable product that leads to being a valuable company. So I think it's a little bit different in private equity, where you have exit strategies that may or may not necessarily depend on the success of the company. And I think that's a slightly different world. But I think in the venture world, my experience is that most, of course not all, but most investors invest with the intention of help working with entrepreneurs to build great businesses. I think that's the intent.
I don't disagree with you on that. What I'm saying from experience on both sides of the table is that you're still fundamentally not aligned, and that the decisions that get made at the board level aren't those decisions. It's not that a VC wants to not build a great company; they have to, because they've got to build something of value to sell to get the return. That's inherent in the model. But the thought process in a decision at the board level with investors can be different, because it's very hard to not break their fiduciary responsibility if they can not rationalize it, defend it, to say we're trying to optimize this great company that we're building, or good company, or okay company, to get the quickest return, because inherently that's how VCs are measured. When you raise money and you go on the road, the limited partners say, what's your multiple and what's your IRR? And you put into cohorts, and you're measured that way. You may have relationships with LPs that'll forgive you if you aren't in the top cohort of in the top of that cohort year, but that's fundamentally the metrics that they're built on. So my issue, or that's not an issue, my hypothesis or experience doesn't say that they don't want to great companies. You have to do that. It's just that at some level you're not aligned completely at that level. A founder wants to optimize for the next 20 years of their business, and a VC says, well, you better figure out how to get me out, because my fund's 10 years and an IRR that ticks for 20 years, unless it's going to be worth $29 trillion, just the math doesn't work. So
Yeah, I
that's a rant, Nick, but
yeah,
it's just experience from what I've seen, like firsthand, being on both sides.
yeah. But to be honest with you, that exists. I'm not going to say that those dynamics don't exist. I don't believe it's a majority of cases, and I believe there's also the other side where you have some founders who are not focused on actually creating much value, but they're more interested in the lifestyle associated with them being a CEO, or them running a company of a size that they can manage. And sometimes the interests are not aligned, not because the venture capital firm is misaligned in terms of building a great business, but because in some cases you have CEOs who are more interested in making sure that the business fits them rather than creating something that could be um, that can outgrow them, for example. So you have both. But I do believe that in the majority of cases that I've been involved in, the majority of investments, whether it's in the private equity side, or when in the private equity it was mostly growth equity, but in the growth equity side and in the venture, the vast majority of investments I've been involved in, I think the investors were very much aligned with management team in terms of what everyone was trying to accomplish. And there have been cases where the investors would say, you know, this is a tough problem we're trying to solve, and we behind you, is going to take longer than we thought it was going to take, but this is a problem worth solving. No, if you're in cases like deep tech and so, that's a little bit different. But because we go in there sometimes expecting that this is going to be tough, and you have to be in for the long haul. Assuming, of course, that you don't allow time to market to increase time to market to make you lose your chances of being successful. So while I agree with you that you do have some of those dynamics, I think you also have the opposite dynamics as well. But I think the vast majority, people are aligned. Sometimes what happens, let me tell you what sometimes happens. And of course, I'm speaking from a venture capital perspective because that's what I am today. But I've been on the other side. I mean, I've started several businesses. Sometimes what happens is when you start negotiating deals, sometimes if the entrepreneur is so focused on valuation that they push things to the point where valuation are so high, in order for the investors to justify the valuation and have downside protection, they have to put a bunch of terms in there. And those terms sometimes could lead to working relationships that may not be completely aligned. That's why I think it's important for both sides when you're negotiating. I've always believed that if I'm an entrepreneur, I want to pick the investment partner I want to have, and then I'll negotiate the terms to make sure that we both feel good about the investment, or we both feel equally unhappy about it.
I agree with you, and I think you made a valid point. And I will say my lens is as an entrepreneur right now. So I'm more, not that I do angel investing, but angel investing is very different than venture capital. Like my limited partner is my bank account and my wife. I mean, right. So, and with capital that I can lose,
Yeah.
quite candidly. Like, I mean, that's the fact of when you go after that. But I will tell you, because as soon as you said it, I was like, man, Nic's got a good point. I was talking to a colleague the other day who has a business and was raising venture capital. I helped her raise venture capital or played a part. I mean, she did the work. I helped her build financials and build a deck that would work. But she executed it and she did an incredible job. So I sent her a text the other day. I was like, hey, I was thinking about you. I was riding my bike and how are you? And because I'd seen something on LinkedIn and she said, I said, how are you and how's the business? I'm doing great and we're doing great. We're raising another round. And I'm saying that because there's this addiction on the founder side and there's this badge of honor of raising money. And my question, I don't care if she raises money ever again. In fact, I don't care at all that she raised money. What I care about is like, hey, are people buying your product and are your sales going up? Not, and I'm not picking on her, but I'm supporting your point that there are people out there and founders and get caught up in it. And I'm not even saying it's their fault. It's just like echo chamber of what you work. Because when you raise money, you talk to other founders who raise money. You don't generally, you may have colleagues and friends who are bootstrappers. But you don't, like, the bootstrappers will look at you and be like, oh, you shouldn't have raised money. I mean, it's just a thing, right? It's the way we're humans. We work with people who are similar at the moment. But I agree with you that there's this like idea that raising money, I don't care, good, man. That's awesome. You've convinced some people, but how are your sales? So I agree with you there. And I do agree with you. The other person popped in my mind is a very good friend of mine, Ty Savage, who's a partner at Revolution. And he has argued for over a decade. He and I met each other probably 2 decades ago when he was the VC at America Online and I was working into marketing. And he has argued for a long time, Nic, to your point, which is entrepreneurs want the highest valuation because there's some level of validation that you've built a successful business. And there's some belief that that's a good thing. Like, but there's cases that you just said where the VC their investor wants to invest, but and likes the business, the team, but in order to invest at that level is going to have to put terms in there just from mere preservation of capital. I mean, you're overpaying. I'm not saying that they're overpaying in reality or not, but valuation is as much of an art as it is a science in early stage investing. So they're going to have to put things in there that are terms, and then those terms become issues. And I think you're absolutely right. And I think in those cases, which I think VCs occasionally do, walk away, and need to. But then there's this, let's all agree that we're humans, and there's this frothy environment where VCs will start competing because there's this belief that this thing's going to turn into $1 billion. And then they get forced into this situation, not forced, but it just happens we're human, into agreeing to do the terms when we all know that, if it goes well. I had a really well-known investor from venture firm, Sandhill, told me, like, look, man, we're not doing this contract because when things go well, like, the only thing we're going to do is look at the cap table and we're all going to divide up the money. We're doing all this stuff so that when shit hits the fan, the market doesn't work, that we all know where we fall. And, I see they're laughing for people who aren't watching on YouTube, but Nic's smiling. I just think that, that's what happens. I think you've made really valid points, and I agree with you. I think everybody always goes into sort of like meeting your partner. Like, everybody goes into it with good intent. And then, when you really get to know each other, how long do you think people should talk to investors before they actually or investors should talk to entrepreneurs before they actually sign up for the deal. Because sometimes it feels like speed dating. And I think the divorce rate's like 65% in America.
Yeah, I mean, it's hard to place a number, but I think you need to take the time to make sure you know what you're getting into. So we have companies that would come to us and make statements like, yeah, we really like you guys. We'd like you guys to invest, but we expecting a term sheet in 2 weeks, so you got to move really fast. And my position on those is usually, I'm not going to make a decision in 2 weeks. So if you have a term sheet in 2 weeks, take it. And if you want me to look at the deal, you got to give me enough time. I'm not going to just jump and do something just because you're going to tell me that you have a term sheet coming in 2 weeks. And by the way, my experience has also proven that 90% of the time they don't get those term sheets in the 2 weeks they told you. I don't know if they're lying or if the people just delayed it, but most of the time it doesn't happen. But we've turned down deals just saying we have to have enough time, and we're not going to jump into something where we don't have enough time. So if you're not going to give us enough time, let's not even date. Let's just move on. Come to us next round.
Yeah, I agree. I had another friend the other day told me, he said, I'm going to be really busy for 2 weeks. I'm running a process. And I was like, oh, you're running a process? He said, yeah, we're going to do 10 days of meetings and then we're going to get a term sheet. And I was like, is the market that hot right now that people just need to deploy their capital, or did that change like last week when the market crashed by 5% in a day and basically crushed tech? But I mean, are you seeing that right now in the market from companies that they're running that sort of? I understand about being efficient as an entrepreneur, by the way. Raising money is extremely hard, and you know this from being on the other side. It's a full-time job, and you're trying to make it less so that you can get back to working on your business. But by the same token, like, am I going to marry the girl that in my case, or woman that I see for 9 days? I mean, sure, there's true love at first sight. It occasionally happens, but I think it's like 9 standard deviations from the norm. So, are you seeing that in the market right now?
We haven't seen a lot of that. I don't know if my partners may have. I personally haven't seen a lot of that. Most of the companies that come to us, quite frankly, come to us because they believe that we have a lot that we bring, and they're interested in us as investors in their businesses, most of them. And so, and I'm not just saying that just to beat our own chest, but and the proof of that is, we've invested in companies where they had other term sheets and they gave us the time, and we've invested in companies where in the same round that other people were investing in, we got better terms, either through warrants or other things, because they really wanted us to be part of the syndicate, and in some cases lead the syndicate. We've actually had other investments where they already had a term sheet, they had a lead investor, and they had multiple people who were interested in investing. And the lead investor said, no, we want to work with Celesta Capital, and we will help make it interesting to Celesta Capital, including sharing terms that they may have negotiated exclusively with us. So generally speaking, we don't see a lot of cases where people are just running a process and say we're gonna go talk to a bunch of people for 10 days, and then whichever one of you guys like us the most we're gonna go with, or which one we like the most we're gonna go with. We don't generally see a lot of those.
Well, I appreciate you sharing that. Are there any terms that are non-negotiable for you? And I'm asking this for listeners out there, not because Celesta Capital. If you could comment in general, that maybe from a VC industry, that someone can expect who's not as familiar with terms, that you're definitely going to, I hate the word require, but that it would be very hard to move on.
But it's different for different companies and different situations. In our case, and I know in many cases where you have, value add investors, having a board seat is not negotiable, for example. I mean, we believe we value add investors, and we can't add value if we're not if we're not in the room when things are being discussed. So for us, having a board seat is non-negotiable.
One board seat?
But in some cases we have more than one, but at least one. Some cases we have 2 board seats, depending on how much money we put in and different things. In some cases, we may have a board seat and an observer. But but we generally will require a board seat. I am not suggesting that there haven't been cases where we've invested without having a board seat, but it's very, very few, and there are other extenuating circumstances that led to that. But for the most part, we had a deal recently that we did where we were gonna do. We loved the company. We were prepared to put the money in. We went all the way through our investment committee and approved it. And then at the last minute, the CEO came and said, we don't want to increase the size of the board, so you wouldn't be able to get a board seat. And we just said, thank you very much. Just get the money from somebody else. Even though we like the company, we really like the company. So that's one of the things for us that's not negotiable. Many of the other types of terms and stuff that often put in has to do with the circumstances. So like I said, things like asking for warrants or things like, putting in certain types of downside protection terms and things, that has to do with the specific situation. So it's not, if it's, people say they like clean term sheets, and we try to do clean term sheets as much as possible, but to get a clean term sheet, you got to have a clean deal. so, and a clean deal means you can't ask for $1 billion valuation when you have no revenue and you have 3 people in your company and expect to get a clean term sheet. So a lot of those things are situational, but for us, having a board seat is generally not negotiable. Sometimes we want to have some say in certain decisions that management will make.
Like what would that be?
Sometimes, for example, some aspects of hiring decisions, sometimes you want to have a say, not always. How much money you spend on the amount of money you might spend on certain things, maybe the kind of cap you might place on the management team being able to spend without board approval or something like that. Little things like that sometimes you have, but many of those things are situational. It depends on the experience of the management team, the kind of things they're doing, and you try to tailor your term sheet to the situation.
I think, would you agree that another thing that's going to be non-negotiable just across the board for most part that someone can expect is in a down round, you're going to still maintain the same level of ownership, if not more. I mean, that's generally.
I mean, sometimes, but that has some negotiation. I mean, sometimes you negotiate that too, but yes, you do have terms like that. Again, a lot of those things come back to valuation. If you come in and telling me that you want this high valuation, then yeah, I'm going to put some other terms in there to protect my downside. But if we think it's a fair valuation, you may not necessarily put those terms in there.
Would you agree that valuations is as much of an art as a science in early stage? Because it's not like,
Oh,
I
yeah.
mean, we can build the comps all day long. I mean, I'm saying public company comps all day long, but building, and then there's private company comps. So it really does come down to, there's nothing that we could say on this episode to say, hey, download this sheet and you're going to get your valuation. There's direction and guidelines and bullet points. And then there's the reality of the company's situation.
Oh yeah, for sure. By the way, I should have added that some things that are not negotiable would be things like preferences, right? I mean, that's not, I'm not going to come in and put my money in and have somebody that came in before have preference above my money coming in. So there are things like that are not
When you say
negotiable.
for listeners' preference, so will you only invest in a preferred round, or will you buy common stock
We
in
sometimes would buy
companies?
common stock, depending, but the money that we put in the preferred round has to sit above the previous investments in the stack, right? We're not going to come in and be putting money in today and have somebody who put money in a seed round sit above us, for example.
Well, when you say sit above, just for listeners, that would mean if you had a 1x preference type deal, right? Because sitting on top of, if you have pari passu, the same rights in the same deal, but you're paying more because the company's 3 years later, then sitting on top of it doesn't matter or not.
Well, it doesn't matter depending on what the exit looks like, right? But yes, but this would be if you your preferences off the structure of the preference will be consistent with the risk that the financial risk you're taking versus the others.
So I guess one thing that I'm thinking for listeners out there, it's really important to set your terms from day one, because I'm getting technical on the exit here, but if a seed round investor has certain terms, you're going to have to be growing at a mad rate to not give your next investor the same, if not at least the same type of terms,
Correct.
right? I mean that's what we're, for somebody listening here, that's effectively translated into making it simple for you, that you got to be really careful. And the tendency is in the early rounds, when you think you need money, is to bend. I mean, but it has a long lasting effect. And I think it's fair. I mean, if you come in, then, and like I said, unless the company's growing like 300% a year, the truth of the matter is they're going to get capital any way they want.
Yeah, and that's why I said a lot of these things are negotiable depending on the circumstances. If you have a company that the early people invested in and at the $10 million valuation, another company is doing 300 million in revenue with 40% gross margin and 20% operating profit, that's a completely different environment.
Yeah, and I appreciate the conversation. I like digging into this, because there's a lot of myths out there, Nic, and there's a lot of things that get written on the internet that people say, and half of it I think is just BS. And I think at the end of the day, everybody who's involved in the company, we're just trying to build a company and make some money. And I don't mean make some money like flip it. I'm saying solve a problem for people and be able to make money doing it. And if you can do that and you can scale that, then you're going to have a good business. And the one thing that I learned, Nic, from my experience was in my early days, I think in my 20s, I got caught up in raising money and doing that sort of stuff. And then what I realized was when the stock market crashed in 2001, which you'll remember, the dot-com crash, was if you build a company that solves a problem that people pay you for, that you can do profitably, and you keep growing that company and you focus on the customer all day long. Now, you got to take care of your people, and you got to take care of, people, your company team. And when I switched to that mindset and I executed on that, this absolutely amazing thing happened, Nic, is that someone came knocking because they knew that we had built something good. They may not know my financials, but once they saw that, everybody wants to be with the cool person. Everybody wants to buy the cool car or the cool product. And if you just focus on that and everybody's rowing the ship in the same direction, then everybody wins.
Yeah, I think to me the key thing to bear in mind here is, as investors, our job is obviously to generate great returns for our LPs. Most people, I believe most entrepreneurs who are trying to build a business are trying to build a business to solve a problem and at the same time, generate wealth. And that partnership between the VCs and the entrepreneurs, if it's a great partnership, everybody ends up benefiting tremendously, and then you can repeat it over and over again. So you have, the next time the same entrepreneurs want to do something, they come back to the same partners, and you do it over and over again, and it's recognizing the value that each bring. And I think for people who want to start companies, and just I've met lots of people who say, I want to be an entrepreneur, I want to start a business. There's a big difference between being an entrepreneur and quote unquote starting a business. There are lots of businesses people start out there that I would not be considered entrepreneurial. So I don't think somebody.
Well, I'm not going to let you, like, what would that be, just out of curiosity? Because I tend to feel the same way, but I haven't been able to articulate that in a good way.
But I believe that an entrepreneur should be creating new demands, new market demand, and helping to increase a market. grow a market, grow new demand for whatever products or services that they're creating. So if you're gonna go start a barber shop that looks just the same as the other barber shop down the street, and all you're doing is splitting the same customers between two barber shops, that's not entrepreneurial. If you're gonna open a bus route, driving the same exact bus route that another bus company is running, and you offer no difference in service, no difference in cost, nothing, that's not entrepreneurial to me. That's just, you're just taking the same pie and you're dividing it among more people. I think entrepreneurship should increase the size of the pie. Yeah, if you're starting a bus route where you get now people taking the bus who would normally not take the bus, I think that's more entrepreneurial. You're creating new demand for the service that didn't exist before you came in, or you're creating a new product that didn't exist before you came in. So to me, when you start a business, entrepreneurs should be looking at making an impact, solving a problem, creating new services, and attracting new people into the market who would not normally be in the market. At least that's how I think of entrepreneurship.
I'm so grateful for you being able to pull that out of your hat because I've been trying to think about. I know that there's inherently a difference, and we talked about it earlier in the conversation, but I've never been able to say that. And I think that's it. Like if you're just a copycat, I understand that there's risk, but it's different. You're not. You're just copying something, and then if you copy something, put it in a new country, and you adapt it, that can be
Oh yeah,
entrepreneurial for
because you bring
sure.
it into a new country, you're creating new market demand in that country using the same platform or the same approach that somebody else was doing somewhere else. That is entrepreneurial. But
Right.
I'll give you an example. I'm from the Caribbean, and I was there a few years ago, and there was a ferry service between two islands, and some guy went and he started another ferry service, and the one that was running before was barely surviving. So you start a new ferry service, and now both businesses are barely surviving because there are no more people traveling. It's the same number of people traveling, and if the same number of people traveling weren't able to sustain one business, they're not going to sustain two. So so now each of those ferries run 3 days a week instead of, so all they've done is just split the market between two different owners, two different service providers. I don't consider that to be entrepreneurial.
I think those are really great examples. And I'm grateful for you taking time out of your day to talk and have a conversation. This has been fun talking about VC and your experience and perspective. And, um, you have real stories behind being adding, it's not adding value, it's being a partner in a business. And you bring capital along with some other stuff. And I think the GoPro story and your other stories are really great. And I'm appreciative of you sharing them. You actually are a business owner, Nic, as a venture
Yep.
capitalist. What does your day look like? Like from the time you get up to the time you go to bed, and hopefully you get 8 hours sleep.
But let me start from the last part. I generally don't get 8 hours sleep. I would like to, but I would say I probably average about 6.5 hours of sleep, which is much more than I used to get when I was the CTO of Flextronics. So I'm grateful for that. So becoming an investor has helped me to increase the amount of sleep I get, which is good. Um, my days are not all the same, but I'm a family man. I have a wife and three kids, and my last child, my youngest daughter, is just graduated from high school, so we'll be quote unquote empty nesters soon. But for me, life really revolves around my family. So my activities tend to revolve around what's, to some extent, what's going on with my family. So even at the beginning of the school year, and my kids were in high school, I would get their calendar and all the stuff they need to be in, that they need me to be involved in, and I would give that to my assistant, and she would put that into my calendar first, and then schedule stuff around that. So oftentimes, my day involves balancing between, family stuff and business related things, and I do try to get some physical activities and other things in there. But I have to admit that usually if I have to sacrifice some things, it's the stuff that's personal that gets sacrificed. Like I may not get to work out for a week because my schedule is just too jammed, and I can't cut family stuff, and I may not be able to cut business things. I tend to be very busy because, as of course, as value-add investors, our companies want to get time from us. They want time to be involved in meetings, not just board meetings, but other things they're doing and advice. And so I have a lot of one-on-one scheduled with the CEOs of our portfolio companies, or I'm having meetings to help them with different things, or I'm reviewing, new deal opportunities coming in, or I'm helping one of my other partners on one of their deals. Because we are not a siloed company. We work together on almost everything. There's at least two of the GPs working on any given deal at any point in time, and we help out wherever we can. It's not who does the deal. We don't get compensated based on the performance of individual deals. We get compensated based on the performance of the fund. So we're always helping out wherever there's something where we can add value, we're jumping in. So lots of meetings, not a lot of time for other things. And, of course, always time for family and friends.
Well, I appreciate you sharing. It's actually, I think I've done 175 episodes with people, or maybe 200. It was the first time I've asked that question where someone has actually said that you take your family's calendar and put it in there first. And I think that's awesome. And because that's the structure. Yeah. It doesn't mean that you can work between all that. So that's awesome, Nic. I appreciate you sharing that. And I have to ask, if you were you are going to give 3 HPT's high percentage tips to listeners out there, either from the business owner perspective or from business owners who want to raise venture capital, or, I don't know, you can steal that last one, like, hey, spend time for yourself, or schedule it around family. What would be your 3 top tips?
Well, I'll pick different categories, but for one, if you're an entrepreneur, I would say focus on making an impact and on building a great business. If your focus is on making an impact and building a great business, every decision you make will be tied towards that. So even decisions of who are the right people to hire. Am I the right person to be the CEO, or should I have a different person as CEO? Who are the right investors for me to partner with? If your focus is on making an impact, you make those decisions differently. So that to me is a piece of advice I'll give to entrepreneurs and business managers and other people in general. I would say always remember that while you have this vision of what you're trying to create, always remember that people are your greatest assets. So you have to make sure you hire well and you treat your people well. So the quality of the team matters. The structure, the organizational structure you put in place that will allow the team to function, that matters. And so everything, in my opinion, most of the time when people are not working out in a job, you could attribute the fundamental problem to management decision. If the person is not the right fit for the job, they didn't put themselves there. Somebody put them there. So it's not their fault that they're not the right fit for the job. If they don't have the right tools to do the job, or the right instructions, or they don't have the knowledge of the vision, or whatever the case may be, all of those are reasons why people often don't perform, and it's usually a management problem. There are very few cases, I've only known of maybe 2 in my whole career, but there are very few cases where people leave home going to work planning to not do a good job. People leave home to go to work planning, hoping to do a good job, and they feel great at the end of the day when they've done a great job and they're driving back home. And so, oftentimes the reason that job is not well done could be tied to management, to the structure, or whatever the case may be. So remember, people are your assets, and remember, to get the best out of those assets, you have to have the right structure, the right people leading them, make sure you share the vision, all of those things. And the last point I would raise is that, execution is really, really critical. Vision is important, and vision starts at the top, and strategy is important also. But execution is really important. Strategy, and don't get me wrong, strategy is the most important thing at the time when you're developing the strategy. Once the strategy is developed, then it's all about execution. And most companies fail because of a lack of execution than anything else, in my opinion.
I think those are great pieces of advice, and I'm grateful for you sharing them with the audience. Where's the best place for a listener who believes they have an investable business for you? Where can they find you?
Well, first of all, if you have a great business idea and you're looking for venture capital investment, there's no place better than Celesta Capital. And the way you find us is we're very easy to find. Read us at www.celesta.vc. Not celesta.com, celesta.vc.
Perfect. We will put that for listeners in the show notes, so make sure you click that. And Nic, thanks a lot for being on the show and engaging in a fun conversation. I really enjoyed it, and I hope you have too.
I certainly enjoyed it, and I thank you for the opportunity. You know, I enjoy these kinds of conversations. As you told me from the beginning, this would be a discussion, a conversation, and not an interview. And I truly enjoy those. So thank you for the opportunity to share my thoughts with you and your audience.
Yeah, you're welcome. Thanks, Nic. Bye, everyone. Nic, hold on 1 second because you're not uploaded yet.